When the market's getting steamrolled like it is today, I try to pull little Johnny Mercer, accentuate the positive, eliminate the negative. Don't mess with Mr. In Between. But what the heck is positive about a horrific day like today? I don't want to sugarcoat things. This is a real ugly tape. You know what this is? Frankly, we have an address for it.
The House of Pain.
However, there are some things you need to remember. Things like the fact that some stocks get cheaper as they go down. Why does that matter? Because there's some genuine buying opportunities here as long as you're willing to be patient and pick up these stocks gradually on the way down. Notice I did not say buy them right here. No statement buys. Just let them drift down. For example, this year we've had a deluge of IPOs, some good, some bad, some terrible. And for months now, we've been feeling left out of the good ones. Every time a company with a great story become public, I tell you, it was worth buying, but you know what? It's why, but only at a price. Don't do it yet. Just wait. Then time and again, these newly minted stocks would shoot up to ridiculously expensive levels where I felt uncomfortable recommending them. Somehow, people on my Twitter feed are claiming that I'm the biggest cheerleader of IPOs. Oh, by the way, go tell that to the bankers who are pushing WeWork when I said it would be a disaster in the making, depending upon where they did price it. I actually did a piece, by the way, last week on this show, talking about how I may have been too cautious in not recommending these IPOs, but I didn't want to hurt anybody. I'm standing by that. Whoa, wow. Guess what? You're finally getting the price break we've been waiting for many of these new issues. Here's one that I really like that just has been hammered. It's called Revolve Group, okay? I mean, this is, whoa, nasty. It's a web-based fashion retailer that's been taking major market share from the big department stores. Not long after Revolve came public in early June, I told you it was a terrific story, but I said, no, you can't buy it. Stock had run up so dramatically right out of the gate, vaulting from 18 up to 34 in its first day of trading, that you never really had a decent buying opportunity. I was not going to let you chase. Remember, we don't chase on the show. So I told you to put in your shopping list, keep your eyes peeled for a pullback. Thanks to this panic-driven market, Revolve's now experienced some massive declines. Stock lost 22% of its value just last week in the wake of what was widely viewed as a disappointing quarter. Then today it plummeted another 14%. A month ago, the stock was at $38. Now it's at 22 and change. This is the lowest level since its IPO. Look at this. See, we said, Well, here I am saying, okay. And that's not because just stock stop at zero, because that's really about 20. So, look, this is about more than one company. I mean, I talk about a lot of different companies with the same pattern. We've seen the same thing, for instance, in other new fashions like Real. That's that online consignment shop. I think this could be this could be the opportunity. I'm not going to run from it. I'm going to embrace it. So let me explain why. Because I know it's hard to even consider buying something that's crashing to earth like these things, especially in retail of all places. I mean, Macy's just reported a woeful quarter. It cut its forecast, sending the stock tumbling 13% today. I mean, it has 9% yield. Nobody cares. How should we go about something like this? Well, you know what? I go bullish on Revolve or the Real if Macy's is getting obliterated. Let me tell you why. These companies are part of the reason why Macy's is getting obliterated. They're disrupting. We like disruptors, right? They're disrupting what's left of the department stores, and it is working. So why don't we start with Revolve Group? The bull thesis here is pretty straightforward. Revolve runs 3 online stores, the high-end Revolve, the super high-end Forward, and the cheaper Super Down. The company's premised on the idea that brick-and-mortar apparel chains were either too broad, like department stores, like Macy's, or too narrow, like specialty stores. Both are being hurt if they're in the mall. Revolve figured they could use the internet to create something in between. Then they built their own technology platform to automate inventory management, pricing, and even trend forecasting, so they can predict what you'll want before you even know what you want. The company's trying to turn the fashion business into a science. They'll launch 1,000 new styles each week as a kind of experiment. Then they double down on whatever's selling best. Isn't this what you want? The old lumbering dinosaur department stores can't do this. This business model allows Revolve to operate with extremely lean inventory. You know, inventory is the bane of a retailer's existence. When traditional retailers have too much merchandise, they need to mark it down, giving you deep discounts and really hurting their profitability. But for Revolve, 79% of its sales are made at full price. Can you imagine? They have a host of popular private label brands, too, and we know private label carries much higher margins than selling product made by other companies. Plus, the company's great at digital marketing. I know no one is even listening. All they're feeling right now is 10-year, 2-year, 10-year, 2-year, 30-year, 30-year, like their hair's on fire. If I had any, mine would be. Check my Instagram. Put it all together, and you had the makings of a fantastic growth story, which is why the stock vaulted into the stratosphere right after it came public. In recent weeks, though, investors have started worrying about the new tariffs, as Revolve sources perhaps as much as 40% of its merchandise from China. Ouch. But I think they can pass the tariffs on to the customers. And more importantly, any Chinese trouble, I believe, at this level, is at last baked in. A lot of people don't feel you can ever bake in China troubles. I think some of these have. Then last Thursday, the company reported a quarter that was widely panned. The stock was annihilated. I think that's a mistake. Look at the actual numbers here. Revolve posted a tiny 1-cent earnings miss off of a 19-cent basis. Their sales came in higher than expected. You know we care about revenues, up nearly 23% year over year. Nice growth. A slight uptick from the previous quarter. We want that. The company had 1.3 million active customers, up 36%. I mean, to me, it sounds like Pinterest. That was a zoom up. How about the full year guidance? While management's EBITDA forecast, that's earnings before interest, taxes, depreciation, and amortization, came in higher than anticipated, and the midpoint of their sales forecast was about $2 million shy of the $605 million number Wall Street was looking for. Still, they're talking about 20 to 22% growth. I'll take that. No one that was up all the way here, no, but down here, yeah. In response, the stock plummeted 15% Friday. I know the quarter wasn't perfect, but that's a pretty extreme reaction. Revolve missed the earnings by a penny. Their sales guidance was a teensy tiny bit conservative, and the stock gets pulverized? How does that make sense? Some of it's because this was their first quarter as a publicly traded company, a little rookie-ish, a little fresh. And when you mess that up even a little, you're going to be punished. I get that. Mainly, though, I think Revolve sold off because the investor base was expecting too much. That's why I told you not to buy this thing when it was trading in the 30s. Bad holders. Your enemy, fellow shareholders. So when Revolve didn't totally shoot the lights out and then gave you spectacularly optimistic forecasts, these weak-handed shareholders dumped the stock. They had to give a big guide up and they had to have a big beat, and they didn't give it. In my view, management's being reasonable. They're responsibly using their cash to build out their lower-end site, Superdown, along with a bunch of private label brands. These guys don't want to overpromise. That's a good thing. And there was plenty to like about this quarter if you cared enough to do the homework. Revolve's revenues accelerated. Their gross margins increased. Imagine any of these other retailers having that happen. Their total orders grew by more than 30%. The platform's still in great shape. That's why so many analysts have reiterated their buy ratings. Some of them even raised their price targets. But in this brutal market, none of that seems to matter, which is why you're being given the chance to buy Revolve at such a huge discount. We wanted a pullback. Now we've got one. At these levels, Revolve is selling for about 29 times next year's earnings estimates, roughly 21 times the earnings estimates for 2021. 20 times earnings for a company with 20% growth? Okay, that's not bad. We've seen a similar weakness in the stock called Real. I don't like that name. It sounds stupid, but you know what? WeWork sounds good, and I think that's a bad investment. Real's the online consignment shop where they'll help you sell your used luxury accessories and apparel. Now, this stock plummeted 23% on Friday. No apparent reason I could find. Then last night, the company reported a seemingly great quarter. Fabulous numbers across the board. What happens? After opening up 10%, I thought that was interesting and perhaps correct. Real got dragged down by the market, giving up all of its gains, ultimately closing down 16%. I'm sorry, that kind of reaction borders on the panic. I don't think that represents rational thinking. Again, I think you can start building a position right here and then buy more if it keeps failing, so leave some room. I mean, we have to understand, these stocks they could be falling knives. Where's my falling knife? Here, we'll use this one. It could be like, no, I like that one. I don't want to do that. What happened to my Bowie knife? Okay, this is a depiction of every single stock that people are thinking, including these, okay? And I have to tell you, you can't catch this. Watch, you can't catch it. See, that would hurt, right? So what you do is you catch a little of it. It makes it so it's not a knife if you catch a little of it. Here's the bottom line. This is a horrifying tape. But stocks really do get cheaper as they go lower. We can't throw out some of these guidance, some dictates that we live by, the dictums. We told you to wait. We waited. And now we're greenlighting Revolve Group and the Real because their stocks have come down dramatically, even though the actual companies are in very good shape. The long-awaited buying opportunities arrived. Don't be afraid to take advantage of it. Just remember, the market's so horrendous that you need to start small and stage your buys gradually on the way down because there's no telling whether these two beaten down stocks will bottom anytime soon. Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.